Welcome everyone. So the GDP now forecast is projecting a 2.4% decline for Q1's GDP, and I believe this value is wrong. In this video, I will explain why, and I will also explain why the recent surge in the SPY or the S&P 500. I usually track the SPY. So the recent surge that you can see here on Friday, which was about 2%, it might be a bull trap. It might be a sell on the news event. I will go into more details why. So let's start with the forecast. As of the latest update on March 6th, we have GDP now projecting a 2.4 decline in GDP for Q1 25. This is bad because 2 consecutive quarters of negative GDP is what usually economists consider a recession. So this is already pointing to the first quarter being negative, and they believe the second quarter will be even worse because of the tariffs. Now, this value is wrong. And it's not that it's wrong, but it's not taking into account data that will make the estimate positive. Let me explain. If we look at the different data sets that GDPNow is taking into account, we can see that on February 28th, that was a very important day. Why? Because we had data in regards to imports and exports. So you can see, probably you can see the mouse and the cursor in the screen. So you can see here that, actually, let me use the chart above, which shows the actual values in billion USD. So you can see that the change in net exports on February 28th went from negative 29, so that was the previous revision, to minus 2048. So that is, again, that's a seasonal adjusted annualized rate. So it's assuming that at the current rate of change, if we continue to this rate over a year, it means that the change in net exports will be negative 248 billion. That is what this figure means. So the key point, we have this change because, of course, you can see this is the actual percentage. So this is not billion USD. This is the actual seasonally annualized growth rate. So you can see imports went up by 29.7%. Yeah, so that means at the current pace, particularly the one in January, if we continue for 1 year, imports would have gone up by almost 30% compared to the previous year. That's what this value means. So, of course, imports went up due to the front-loading effect of businesses importing like no tomorrow because of the fears of tariffs. So of course, there was a front-loading effect, and this is already shown in the data. Now, this has a negative impact, as you can see below, of 3.7 percentage points in the GDP estimate. However, what is key is that the model is not taking into account the increase in inventories. Yeah, let me explain. If I go back to the table, you can see, of course, on February 28th, the significant change in net exports. However, the change in private inventories, this value right here, that's the change in inventories, has not been revised, has not been updated. And the reason is because the data is not coming up until March 17th. So essentially, the model is taking into account that there are a lot of imports, but it's not realizing that inventories have increased. Yeah. So the net effect of imports is actually zero because you are importing products into your country. Okay, so the GDP will go down. However, you have to take into account that those imports, they add up as inventories. And that's exactly this value right here. So you can see that from all the revisions, that value is constant, more or less constant between 23 and 25, which is the same. So what's my point? My point is that on Monday, March 17th, we have the next update for GDPNow. And coincidentally enough, if we look at the calendar of the major US economic reports, on Monday, March 17th, we have business inventories. So we have data from inventories. And I believe that after March 17th, and not just after, but during the day, I believe the S&P is going to do what people call a sell on the news event. In other words, this increase is because the market is already seeing that GDP now, is going to go from negative 2.4 to probably positive 1.5 or whichever value, I don't know, but it's going to be positive because you already take into account the inventories. And I believe it's going to sell off on Monday just because the market is pricing in this positive announcement. So this is one piece of data that you have to take into account for March 17th. And the other one, if I scroll down, is on March 27th, where we have advanced retail inventories and advanced wholesale inventories data. So this, again, is going to revise the GDPNow estimate because, of course, the model will have more data set, more information to account for a more accurate estimate. Great. So looking at other estimates, because, of course, there are other, for example, the Fed Reserve of New York, they have their own estimate for Q1's GDP. And according to them, things are not that pessimistic. So you can see that as of March 14th, their nowcast is projecting a 2.7% increase in Q1's GDP. So this is a huge contrast to the negative 2.4 from the Atlanta's Fed. And you can see also the impact of the data releases. So in this case, you can see each day what data sets are being released and how that impacts the model. So something to take into account. However, the one that I tend to trust a lot is the Moody's Analytics high frequency model. So this is estimating Q1's GDP based on, this is a proprietary model. I don't have much information on what that model is, but I trust Moody's. So I don't know, 1.2 seems to be a more reasonable value. And if you're wondering why is there such a drop, because if you look at the calendar of the tariffs, I think I have one here. This is the one. During the first quarter of this year, the only tariff that has been implemented is the one on China. So we had 10% on China effective since February 4th. So this indeed will be impacting those, probably consumer spending in Q1. However, the big effect, which is the 25% on Mexico, Canada, the EU, possibly, as well as steel and aluminum, autos, semiconductors, all these effects are going to enter into effect in the second half of Q2. So I believe the reason why Moody's and other forecasters are projecting 1.2% for Q1 is because of consumer spending taking a break, as well as businesses delaying investments, because there is a lot of uncertainty in regards to the tariffs. And these tariffs were already noted during Q1. And of course, businesses, they already knew that there's going to be some turmoil to take into account. So maybe they delay those investments. So that's why I think GDP is going to still be positive, but it's going to decline from the usual 2.5, almost 3% values that we've seen in the past. In fact, I have a chart here. You can see the actual values. This is the official BEA estimate. Not estimate, but release. And you can see the actual values. And, Q3 23, it was over 4%, but usually these values anywhere between 2.5 and 3%. So yeah, there's going to be a drop in Q1. I believe consumer spending and investment, these two are going to affect Q1 data. What you see on this page is for Q4, so you can see the different contributions for that estimate. And in regards to the BEA's release, April 30th is going to be a very important date because that's where they provide the advanced estimate for Q1. So that's where all the doubts will clear out and people will actually know, okay, the actual value for GDP in Q1 is X. Great. So other things I wanted to show you was there is a heuristic, I guess, if you call it like that, the inverse yield curve. Essentially, it's saying that when the yield on shorter expiry treasury bonds, when that is above longer expiration dates, there is a risk of a recession. I don't usually tend to trust that because you can see here in 2023, the 3-month yield on a treasury bill, it was about 5%, significantly above the 10-year. So yeah, you can see what the stock market has been doing since 23. So I really don't trust that inverse yield heuristic. Lately, you can see that, shorter term yields like the 3-month is quite close to the 10-year. So, well, something to take into account, but yeah. So I think that's all in regards to the FOMC. There is a meeting on the 19th, I think, on March. So it's going to be interesting to understand their stance on the interest rates, because they have two different factors. They have unemployment on one side, which, of course, if you see unemployment ticking up, you decrease the interest rate. However, if the tariffs, they show an increase in inflation, usually the idea from the federal fund is to increase the interest rate. So they are in a battle to understand what they do. Of course, in March, the consensus is that they will not change the interest rate, but later on during the year, particularly as forecasted by the CME, I believe in July, yeah, the market believes that there is a good chance for the interest rate to go down to the 400 to 425 level. So something to take into account as well. And I believe that was it. So I have another pieces of news that, well, there is a timeline. So April 1st, as you may know, this is an important day because the U.S. Trade Representative, the Department of Commerce and other U.S. agencies will be evaluating the impact of other countries' trade practices. And the Office of Management and Budget will provide an evaluation by July. So until then, there is some room for negotiations between the EU and the US on those tariffs. However, the EU, they already confirmed that they will be implementing the tariffs effective April 1st. Yeah, so their tariffs on American beef, poultry, bourbon, and motorcycles. So there you go. I think this is the update, something to take into account for the next few days, particularly for Monday, as I believe this increase that we've seen on Friday might be a bull trap. And probably people will be selling on the news that GDPNow has revised to positive values. But everybody's already expecting that because the model is not taking into account those inventories that I mentioned before. Great. Thanks for watching, and I'll see you in the next one.